This week, homeowners insurance. It's become the new mortgage payment for many retirees. More after this short message.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back. Are insurers in your state requesting yet another approval for another premium rate hike? Likely they are. Newsweek reports that Florida's largest insurer, Citizens Property Insurance Corp, has requested a 13.5% rate hike, but says it needs a nearly 93% increase to match the competitive marketplace. Citizens Property Insurance is the state-sponsored insurer of last resort, an insurer that many Floridians have flocked to in the wake of several insurance companies ceasing business in the Sunshine State. Today, Florida has the highest home insurance rates in the nation. A recent study by the virtual insurance company Insurify reveals that in 2023, Florida homeowners paid an average annual premium of $10,996, or an average of $916 a month, a payment that rivals previous or existing mortgage payments. In 2025, the average annual homeowners insurance premium in Florida is projected to be in excess of $11,000. Consequently, the Florida retirement dream has become a nightmare. Florida was once among the top-ranked states in the nation, attracting new residents, especially during the COVID-19 pandemic. Those moving to the Sunshine State were attracted to the warm climate, lower real estate costs, at least at that time, and remote work flexibility. Retirees moving to Florida benefited from no state income tax, which maximized their income from pensions or retirement accounts, all benefits for retirees. However, for many, skyrocketing homeowners insurance, elevated home prices, and signs of an unstable real estate market have turned the Florida retirement dream into a nightmare. So, what was once the nation's most attractive state just a few years ago now ranks 8th in the most desirable states in which to retire. Bank Rates Analysis weighs affordability, overall well-being, and the cost and quality of health care and crime rates for each U.S. state. And it found that Florida ranked 8th for the second year in a row, behind Delaware, West Virginia, Georgia, South Carolina, Missouri, Mississippi, and Pennsylvania. Florida retirees who can no longer afford homeowners insurance premiums have just a handful of choices, and few of them are appealing. The first option is to relocate to another state which has lower insurance premiums and also a moderate or low cost of living. Now, several of these states can be found in the American South, such as Alabama, West Virginia, Tennessee, and Kentucky. Floridians may also find relief in Wisconsin, Iowa, Nebraska, Ohio, and Indiana. Another choice for Florida retirees is to simply stay put and take the financial hit. And for most, this likely means increasing their retirement withdrawals to cover the higher cost of living and insurance premiums, which will substantially shorten the lifespan of their retirement savings. They'll pay now, but suffer the consequences later. And those who are unwilling to relocate or take larger distributions from their retirement nest egg, they may turn to the home itself that they can no longer afford for relief. Now, how retirees choose to accomplish this will have a direct impact on their monthly cash flow for years to come. A HELOC, or a home equity line of credit, does give a homeowner a credit line based on the home's value and remaining equity. For the next 5 to 10 years, the draw period as they call it, the homeowner may access funds from the credit line up to the maximum limit, assuming that the lender doesn't freeze or reduce the available credit due to market conditions, and it's happened before. During the draw period, the homeowner is only obligated to make interest-only payments. However, at the end of the draw period, the remaining loan balance amortizes into full principal and interest payments, which could create a payment shock for a homeowner, especially on a fixed income. Another alternative is a reverse mortgage. Now, similar to a HELOC, the loan does provide the homeowner access to a portion of their home's value if they have enough equity. But unlike a HELOC, reverse mortgages do not require mandatory principal and interest payments each month. And the credit line, it can't be frozen or reduced just because of a worsening housing market. Should homeowners insurance become the new mortgage payment for many retirees, especially in Florida? Absolutely not. Yet, that's the reality many face today. Even worse, those without a mortgage may choose to forego insurance coverage altogether and risk a complete and catastrophic loss of what is likely their largest asset. Reverse mortgage professionals would do well to partner with local property and casualty insurance agencies to possibly assist those who can no longer afford their homeowners insurance premiums or have chosen to cancel their coverage altogether. Now, what are your thoughts? Leave your comments in the comment section below. And also, if you'd be so kind as to share today's video on your LinkedIn post, we really appreciate that. And I see that each and every week. Don't forget, we have a YouTube channel where you can subscribe and hit the notification bell. That way you never miss our latest content. And speaking of content, each and every week we bring you the latest reverse mortgage related news, and that is Heckham World Weekly. We have both an audio and video edition. Thanks so much for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find here at Heckham World. Have a great week.